Good afternoon and welcome to AROBS Q1 2026 earnings call. Before we begin, I would like to mention that this call is being recorded and that the recording will be uploaded on our website by Monday the latest. As stated in the call invite, by joining this video conference, you automatically and implicitly consented to being recorded. If you do not consent to being recorded, please leave the call. Firstly, I would like to introduce the management that is here with me today and will present the results for the first quarter of 2026. I am joined today by Voicu Opran, Chief Executive Officer and Chairman of the Board, Aurelian Diaconu, Executive Director, Software Services, Ovidiu Bojan, Ovidiu is not here. I got used to having him, but I am happy to say that we do have three new faces joining us today. We have Ștefan Frangula, our recently appointed Chief Financial Officer, Adina Suciu, Chief Integration Officer, and our latest appointment from earlier this week, Porter Hanley, our Chief Revenue Officer. My name is Zuzanna Kurek, and I'm Investor Relations Manager at AROBS Transylvania Software, and I will be moderating today's call. In terms of the organizational aspects, we will follow a standard call setup, which means the management will deliver a presentation outlining the Q1 2026 results, and later we'll have a Q&A session. Please note that all the participants are put on mute. If you would like to ask a question, please type it in the chat box. Feel free to do so during the presentation, and we'll answer all the questions in chronological order as soon as the presentation of the management is over. Last but not least, I have to state that we might be making forward-looking statements today during this teleconference regarding the future performance of AROBS and that actual results may differ materially. We encourage you to review the disclaimer that we have included in the presentation, which you can see right now on the screen. This disclaimer applies equally to all statements made in today's call. So we have now went through the introductory part, so we can kick off this call. And I would like to firstly invite Voicu Opran, who will share some insights about our performance in the first quarter of 2026. Voicu, please.
Yes, thank you very much. It's great to be again in the Q1 Investor Relation call. I'm here, as you see, with Aurelian Diaconu, Porter, Henny, also Adina and Ștefan, so that shows I guess the maturity of the operation and what we are doing and what we plan to do for the future. And going back to Q1, as you see on the presentation and was also presented, the revenue increased 20% compared with Q1 2025. It reached RON 144 million. EBITDA compared with Q1 was 3% up, 18 million, and net profit is plus 12% compared Q1 2025. The quarter was supported by continuous growth in the software services and software product, alongside the sustained activity of the integrated system, particularly in the public sector. Profitability continued to improve, which is a great gradual impact on the integration, optimization, operational discipline. We'll come a little bit further with that. During the quarter, AROBS continued to strengthen its position as an integrated international service platform. And we combine software product, proprietary software services, proprietary products, and digitalization project across multiple industry and markets. Turnover and geographic distribution, as you see, Romania is still the highest. Romania is almost 40%. Europe, excluding Romania, is 43, US 35 million, and others 8. So as a total of 144. US, it's still 20, it's in the one quarter, and our plan, and that's why also our partner Porter is here, is planned to increase in the future. Going further, we introduced already the one AROBS strategy. And that's confirm AROBS transition toward more integrated, mature, and operational efficiency business model, following an extended period of expansion and M&A driven. The quarter was supported by continual growth across software services and software products. Also, integrated system showed some good data. In the context of integrating capability and accelerating cross opportunities, Adina Suci joined AROBS as Chief Transformation Integration Officer, coordinating integration operational transformation. The group also continued to prioritize the expansion of the proprietary software and high value added solution. And you'll see in the software product the add-on of the tachograph, the business that is also adding more opportunities for us in the product area. The group presence in the US remain a strategic priority, and as it was, both from commercial perspective, but also from strengthening our position as an international technology platform. 2026, Stefan Frangulea joined AROBS as Chief Financial Officer, contributing to the strengthening of the group financial management and supporting toward transition of integrated and more scalable operating platform. Starting May 2026, Porter Henny was appointed as the Chief Revenue Officer of AROBS Group, reinforcing the group focus on the commercial alignment, enterprise client development, and expansion of AROBS internationally, with particularly focus for the US. Following the several years focus on scale expansion, 2026 marks the beginning of the new phase, focused on the operational leverage, profitability improvement, and sustainable long-term value creation. Segment highlights, I would add the software services increased 28% year-on-year and 8% compared with Q4 2025, mostly supported by Codingscape and GESS, Global Engineering Service Solution, as well as contribution of the project delivering during the quarter. The segment continued to benefit from the group international exposure, especially to the United States and Western Europe, while maintaining strong delivery capabilities across multiple industries. And the evolution of the segment reflect both the contribution of the group M&A and continual focus on expanding high value added service engineering capability. So that's one vertical, as we know. Software products increased revenue 21% compared with Q1 2025 and remained broadly in line with Q4 2025, supported by both organic and contribution of SVT Electronics following the integration into the group. The segment remains one of the strongest profitability drivers and gross margin improvement to 55% in Q1 from 53% in the same period last year. We continue to prioritize the expansion of the proprietary product as we see and software solution, including also verticals targeting financial services, transportation, and digitalization project. Going to integrated system, revenue remained at the solid level in Q1, in line with Q1 2025, which was a great quarter. Also 2025, reflecting continuation of the large-scale public sector digitalization project. Segment continued to be supported by the project carried out for National House of Public Pension alongside additional implementation activity. Integrated system remained one of the pillar for the group, providing long-term visibility, recurring implementation and activity, and differentiation of the revenue stream. That's Q1. Talking about consolidated financial results, I will underline a little bit and then I will let Stefan to continue. We reach a consolidated amount of 144 million, 20% increase compared with the same period last year. Total cost of sales increased broadly in line with revenue, reflecting the higher level of operational activity and contribution of the companies integrated in the group in the last 12 months. Within the software product, revenue growth outpaced the increase in the cost of sales, supporting the improvement in the gross margin at the segment level in the software product. Operation profitability remained at a solid level during the quarter, despite the continual impact of integration cost and expansion of the operational structure. Net profit increased 12% year-on-year to 7 million, while net profit margin remained stable compared to Q1 2025. Now I will pass the microphone to Stefan to present a little bit revenue versus budget of 2026.
Thank you, Voicu. It's a pleasure to meet you today. Before reaching the numbers and the details on the numbers, I would like to underline one thing briefly. First of all, what to expect from me as a group CFO. I strongly believe in financial discipline. My focus will be on the quality on the numbers that we are disclosing to you and to the communication with this target audience. Now, looking at the numbers, as Voicu was mentioning, Q1 specifically, it's a clean quarter with a real 20% growth of the revenues. And with the specificity, which is worth mentioning, that we are along the lines for the three business segments in the budget. Software services and software products, we are just in the budget as established as the consolidated budget with which we approved last month. And then in integrated services, we do have an increase, which is to be understood from the point that we were able to push faster in time and to commission faster in time some of the works on the integrated systems. So the increase in this quarter would be probably compensated with the values in the other sectors. The contracts in the integrated systems are quite important because they provide the visibility for us and they provide the stable margin. And it's also a matter, as Voicu is mentioning, in which we are also helping to the development of the governance and of the life in our country. Moving to the next slide 13. In terms of revenues versus budget, Q1 2026. As we mentioned, everything was in line with the targeted budgeted or exceeded in all the segments. The part related to the integrated systems I mentioned. Moving to the slide 14, which is the full PML bridge. This is the slide where I would like to spend some more time. We have this gross result of 10 million, up 8%. Sales and marketing expenses, 7 million, up 12%. G&A up 16%, 19 million, and operating result 9 million, broadly stable. EBITDA 18 million, up 3%. So the question that probably all of you would like to ask is how to explain 20% revenue growth converting into this 3% EBITDA growth with an EBITDA margin down from 14% to 12%. Now, let me be precise about this because this is the most important number on the deck and on the slide. Being the year-on-year comparison and comparing with Q1 of 2026, EBITDA is not weak. Basically, it's 20% more than our Q1 target established by the budget. The explanation for this is the revenue mix. The fastest growth this quarter came from new integrated systems projects. And these are the projects which are, as I said, very valuable for us, but they don't necessarily have a similar level of margin like with our overall portfolio, especially when we are speaking about the early delivery phase. When the mix will shift during the year towards more completion of these projects, the blending margin will improve. Second, subcontractor costs. We have an increase in subcontractor costs, but this is due to two things. First of all, integrating the new companies in the group, which come with their specificity of activities and split on the subcontractors. And then it's a matter of assumed flexibility. Yeah, in order to comply and to have the resources for the peak activities, this is a flexibility working on the subcontractors, which allowed us to have on the other side -10%, -11% below the budget in the personnel cost. So this is the explanation related to the EBITDA versus revenues increase. Then one point is that I would like to really make point is that the companies that we're integrating are bringing competencies, are bringing portfolio, are bringing some knowledge, but they have various levels of profitability. Yeah, in some cases it can be lower than the average profitability on the company. In some other cases it can be increasing higher. For example, SVT, which has a very strong profitability. So it's a mix. It's not it cannot be seen that through the acquisitions we are adding higher margin or lower margin, but this depends on each transaction. Speaking about the expenses of G&A, specifically out of the 2.7 million year-on-year increase, 2.4 are related to the consolidated companies through the merger that we have done, and then new consolidated companies, and then 0.4 is related to acquisition-related consultancy spend. Yeah, if we exclude this, the G&A is flat. What I would also like to mention is that due to our focus on managing the currency risk and managing the position of currencies and cash, we have a net positive result, also financial result of RON 1 million versus essentially zero in Q1 last year. So this is bringing additional contribution to the profitability. So net profit, it has a relatively stable margin compared with last year, and it's coming at more than double the budgeted figure for the quarter. Moving to the slide 15, which is splitting the organic and M&A performance. Here there is a clarification that we would like to mention. There is one important change in how we present this starting from this quarter. Basically, we have reviewed the definition of the M&A perimeter. Previously, the acquired companies were considered inside the M&A bucket for an extended period of time, after the listing on the main stock exchange, the transfer to the main stock exchange. Now, starting with Q1 2026, and with the merger that we have done with the 5 companies being absorbed by AROBS, the reporting criteria is that the M&A category only includes the companies in the year in which they are consolidated into the perimeter and the year after. After that, their contribution moves to organic. This reflects the reality that now we are moving to a faster pace of operationally integrating and absorb the companies, like we have done with the 5 companies formally merged in 1st of April. So after the year of consolidation and the next year, the company ceases to be a separate unit which is under M&A, and it's put under the organic. So from this point of view, this is the explanation for the organic component growing from 78 million to 122 million. There is an important component which is coming from this reclassification. Moving to next slide. The software revenues performance. I will invite Aurelian to give details about this business segment.
Thank you. Thank you, Stefan, and hello to all of you. I will try to be brief about the results for the first quarter of this year. First of all, the first thing that I would like to mention here is the authentic stability that we have witnessed for the first quarter, which is a very important element here because of the many cross currents that we are facing, be it the geopolitical, be it the AI, and so on and so forth. We are not in a short supply of challenges on this environment. So this stability, it's present pretty much on all business verticals that we are present, maybe with the notable exception of automotive. But even on automotive, we see a far more stable environment that we have witnessed for the previous quarters. And that's somehow encouraging because the OEMs, we are seeing new opportunities entering to the market. They are far from the volumes that we have witnessed, let's say, in the previous decade, but still signs of stability are present, and this is an important topic. Since many of you are going to notice an increase of the cost as well, I would like to point to a few of the efforts that we are doing, and that it's mainly on two directions. One, it's the AI adoptions. And on this topic, which is of critical importance for us, I want to mention the investment that we are doing in many internal projects that they are developed not only for the benefit of having maybe sooner or later some products, but also for acquiring, for developing some stronger capabilities on the AI front. And that, of course, comes with some cost. And that cost, I think it's going to be a solid platform for the future developments that we are going to enjoy sometime soon. Also, another very important element is that we have, reconstruct the sales force, and with that, our colleague Porter will give more details on that topic. Will come also, cost of investment on this front, and we are looking forward that those investments will produce benefits in the quarters to come and the years to come. And that also has an impact in our costs. So a slightly increasing cost comes from those two main directions. Another very important element that I would like to emphasize here is the fact that we have doubled down our effort on the BFSI, banking, financial services, and insurance, where we have witnessed so far some very good opportunities that were already secured, but also we expect here some very interesting development to come in the next quarters and in the next years. So BFSI for us will be a very important element of our strategies for growing this segment of the software services. And we are looking forward with a prudent optimism, but optimism nonetheless. We hope that the challenges that we have witnessed for the previous 2 years should be history, and to have a solid, evolution for this year. Thank you very much. I will stop here, and I will welcome your questions in the second part of this event.
Going to the product, software product performance. I'm continue that. Software product reached 27 million in Q1, 21% increase compared with the same period last year. The segment continued to contribute for both organic and contribution from SVT Electronics following the integration into the group. Cost of sales increased at a slower pace than revenue, supporting the improvement in gross margin to 55%. The segment continued to represent one of the growth's strongest profitability driver, supported by high value added product and scalable proprietary solution. We continue to prioritize investment in proprietary software product and vertical specific solution with long-term growth. As you see, in the details, the improvement, gross margin improvement, which is from 53 to 55, and basically the cost of personnel third party are kind of the same, reaching a total of 16% increase versus 21% software revenue. So that's a good indicator that the products are going. And on the interesting side, we are seeing in the product, as much as the cost of gasoline is increasing, we are seeing companies interested more and more in monitoring their activity and their consumption for fuel, and controlling the driver way of spending the time with the vehicles of the company, or improving the spend in that product area. Going further to integrated systems, Integrity system remained at a solid level in Q1. Segment activity continued to be supported by large-scale public sector digitalization, particularly National House of Pension, public pension. Cost of sales remained stable during the quarter, in line with the evolution of the segment, and gross margin remained stable at 14% in Q1, reflecting a consistent profitability profile at the segment. The integrated services continue to provide long-term visibility through existing project and ongoing public sector implementation project. Going further, I will get that. Maybe Porter, if you want to add a little bit more. Sales and marketing expenses, we see an increase from almost 6 million to 6.7 million. In Q1, we see that improvement. The evolution of sales also reflects the continued evolution of the group international commercial presence, especially in the US, and the increase remain aligned with the group's strategic focus on international operations supporting long-term revenue growth. Porter, if you want to add something there.
I would.
Yeah, we just.
I can.
Yes,
Yeah,
Stefan,
please.
go ahead.
I would just add that basically the increase is fully explained by the addition of newly consolidated companies and the effort related to the new businesses that we are approaching. Yeah, there is no underlying step up in our organic marketing spend. And then, of course, Porter will give the details related to our go-to-market focus on the US market. There are also some separate section about that further on. Next slide, it's about the SG&A, the sales general and administrative expenses. This is up to 2.45 million from Q1 last year, which is some 16% year on year. This is coming as follows. 2.4 is coming from newly consolidated companies. Basically, the increase explained by the perimeter. And then there are also some costs related to consultancy costs related to M&A, related to link to GSS transaction, and also the project of merger by absorption. If you are eliminating this, basically organic G&A growth is essentially flat. So there is the increase that you see is just the mechanical consequence of consolidating more companies and implementing the One AROBS merger, but this will bring the efficiencies that will be seen in the next quarters to come. Going on the balance sheet, the next slide, 21, the consolidated balance sheet. We have a total assets of 720 million, which is up 5% versus year-end 2025. Main movements are fixed assets up 10% to 366 million, driven by the recognition of goodwill and customer relationships on the GSS acquisition, GSS. Together, this is adding around 32 million to the intangibles. Cash and cash equivalents of 211 million are down 24 million versus year-end. Movement being explained especially by the payment for the GSS acquisition. We generated in this quarter 16 million of cash, operating cash flow during the quarter, and used 27 for the acquisition itself. On the liability side, the bank financing is decreasing some 6 million compared with the year-end, reflecting scheduled repayments. In terms of total bank debt to EBITDA, we have a 0.39 times, which is very conservative. So this is showing a very conservative leverage profile that gives us the capacity to fund the next stage in strategic execution of M&A transactions. Total equity at 484 million, up 2%. On the topic of capital structure, you saw that we have communicated on the 18th of May a market share increase of approximately 3.2 million. Which is under the existing approval taken from the past with power of attorney for the board of directors for implementing this. And this is related to the settling of the acquisition of remaining 30% of Codingscape transactions, which is bringing the Codingscape percentage to 100%. With that, I will hand back to Voicu and to Porter in order to explain more about this US opportunity.
Yeah, so I will continue with the concept of building one AROBS. And here we want to generate a unified operating model across the group, aligning process, governance, and consolidating across business unit. And for that reason, I would like also to introduce Adina Suciu, who will explain a little bit what we are going to do and what is the plan compared with related to integrated companies for the future. Thank you, Adina, for joining.
Yep. Thank you. Happy to be here. So good afternoon, everyone. First of all, I'm thrilled to start my journey at AROBS Group, yeah, it's a company that, in my view, really stood along the years through its entrepreneurial spirit, drive, and constant ambition to grow and drive innovation. In my role here, I will be continuing what has been built so far. However, also I will be contributing also to the next growth phase, growth that could derive from maximizing the potential and synergies from the acquired companies together with the whole group. And everything will be done under one umbrella and one unified operating model. Specifically, I will be coordinating the integration and business transformation of the acquired companies in order to enable scalability and also generate operational efficiency, effectiveness, but also to drive or contribute to higher value generation for both clients and employees across the group. I really believe that all this will consolidate the market positioning of the group and will enable a scalable technology platform that handles clients across multiple geographies, but also employees. Yeah, and looking forward for what comes next. Thank you. And then I will pass the mic to Porter.
Thanks, Adina, and thank you, Voicu and Aurelian. I'm excited to be here today and speak with you all. I obviously come to this role through one of the acquired businesses within AROBS, which speaks to my enthusiasm about what we're building here. I'm excited to take what we've learned growing together and apply it across the group. So to start, the US is the largest software market in the world, and it's importantly, the fastest to move AI out of pilots and into real enterprise deployments. That spend tied to that, companies rebuilding their software so they can actually use AI, is large and accelerating. And the largest software budgets on earth sit in that market. So for our AROBS, here's the part that matters. We already compete there. As you saw in Stefan's slides, the US contributed 24% of group revenue this quarter. And we're building for the enterprise leaders across multiple verticals in the most demanding market in the world. So importantly, we're not entering the US, we're already in it with direct enterprise exposure and a delivery model that holds up against any firm. AROBS sits at the intersection of three things that rarely show up together: AI transformation, deep engineering talent, and real enterprise demand. And that intersection is the large long-term opportunity for our group. Next slide, Susanna. So what clients want is changing, and it's the second thing I want to flag for the call here. The demand for this type of work is morphing from time and materials to outcome-based. For the last 20 years, software services were sold by the hour, headcount and effort, and that era is changing and morphing. Enterprise clients still want capacity, but they want to know that their consultants are using the best AI tools to save money, deliver faster, and teach their teams best practices. This is repricing the whole services industry, and the firms still selling undifferentiated hours are going to be on the wrong side of it. So AROBS already works this way, And the proof is the simplest kind there is, net new customers that are choosing us for it. And the last slide, Susanna, please. And I guess that brings me to what I'm here to do. I think AROBS is one of the most exciting companies there is. Certainly in Europe, it's growing. We have 1,200 engineers, 27 years of profitable growth, and among the first groups in Europe to be certified for AI management. And that's a real foundation. My move as the CRO is to put a sales-led growth engine on top of it. So in three lines. One, cross-sell across the group. The integration work Adina just walked you through is the foundation here. You cannot cross-sell across business units that are not integrated, and now they are. That turns two complementary units into a single selling platform. Two, a unified sales-led go-to-market, which means named software offers tailored to each industry vertical that we're in, repeatable, not rebuilt from scratch. And three, win the AI modernization wave. The software budgets growing fastest right now belong to companies that have to modernize to take advantage of AI, and that's exactly how we work. So to close it out, engineering depth in Europe, commercial reach in North America, and one global software platform. And that's what we're building. I'm excited to meet you all, and I guess that probably transitions us towards Susanna and questions.
Thank you very much, Porter. Indeed, we now concluded our presentation for the first quarter, and we will now be opening the floor for questions. I see we already have a lot of questions, but just a kind reminder to everybody, if you would like to ask a question, please type it in the chat box. For the sake of those who will be rewatching the recording of this call, I will be reading every single question aloud, and then the management will address them one by one. So the first question: thank you for sharing the details and explaining the EBITDA result. Can you share which costs will decrease as part of the One AROBS initiative, and from which quarter should we expect to see this improvement?
Yes, thank you for the question. The point is that the first category of costs will be the G&A costs, where we had the situation in the previous period when we were buying companies that were some functions which were duplicated, and now that those functions can be optimized and can be done in a centralized way. This is the first approach, which will be important in terms of having general administrative expenses, which will be kept in control. And this should be starting to be seen in the next quarters during this year. The other element which is important is the one which was mentioned by my colleagues. It's not only a matter about optimizing on the costs, but also optimizing on the revenue, in the sense that we'll have a new approach in terms of, selling to the portfolio of customers from all the business lines, and improving in terms of cross-sell and getting more of the wallet share of the customer and optimizing on that. So we are not only looking on cutting the costs, so we are still having this approach related to growing the revenues.
Thank you, Stefan. The next question: which verticals and geographies, US versus Europe, are driving the revenue growth in Q1?
If you are looking at the split of revenues on the areas, we have grown quite homogeneously on the geographies. It's not one geography which is performing significantly better than the other. What I would like to underline is that we are at 60% and more of revenues outside Romania, which I think is quite an important element in terms of us, mitigating the risk, building a resilience for us, and building truly an international and global player, which is not depending on the context of the local market. Also, you have seen in the presentations that we have put together related to US opportunity, that we do see indeed quite a important opportunity related to the US market, for the reason which were mentioned by Porter, Voicu, and Aurelian. We see that there is more dynamic there for the future as an opportunity compared with the Europe. But of course, we will not let's say ignore Europe as such. But in terms of opportunities, we are looking at the biggest market as the biggest opportunity. What were the main drivers? Or would you read it, Susanna, or?
Yes, I'm reading all the questions.
Yeah.
What were the main drivers behind the decline in gross margin from 24.5 to 23.6%?
Yeah, as I was briefly mentioning, this is also shown in the decline in the EBITDA, also is transferred there. It's an element which is to be considered in several arguments or in several areas. First of all, we are comparing with a very good Q1 2025. In terms of budget, we are above the budget in terms of profitability and in terms of revenue compared with the budget for this year. Second of all, we have the situation with the mix of the companies that we are integrating, because we are integrating also some companies which are having higher margins than our average margin, but also in some cases, some companies which have lesser margins. But there is an important component of, combining and having a more complex offer to our customers, So from this mix and from this perimeter mix, it can be also an impact. Also, we had this element related to the fact that there are some projects in the integrated systems which are having a lesser margin than the average, and they have a long period for being recognized as a revenue, and in the first implementation phase, we have expenses for that, but not necessarily recognized in revenues.
How did the automotive vertical perform in Q1?
I think I can address this question. I was alluded to this a few minutes ago, but happy to expand on that. If we compare it with previous year or maybe previous 2 years, the environment was pretty dry in terms of new opportunities, in terms of new platforms that were launched by OEMs. And this is fundamentally tied up to the level of sales or new car sales, especially in this part of the world, in Europe. Today, we see a bit of more alive market. There are some new projects launched on the market, and we are happy to say that, first of all, stability, it's the key element that came to mind when I will describe automotive, but also new opportunities are entering to the market, and we have some biddings, and we expect in the future, let's say in the coming months, to have some new projects that we are going to secure. Nothing spectacular, but still a growth is to be expected this year in the automotive. So again, a prudent optimism versus very, very dry, if not a corrective market in previous year.
Thank you. The next question. Among the companies integrated this year, which ones have been margin accretive?
I will not give necessarily too much detail because this can be also like commercial information. Also, as I mentioned, there is a various mix of margins brought by the companies. The companies which are on the product side are the one which are the most interesting. For example, in terms of SBT, which is complementing with our track GPS, we have there a very good margin, which is amongst the best in our group and is contributing to that. Generally, the product side is the product which is the most profitable and is the product in which we are really focusing on increasing this part of productivity, and it's shown also in the increase of the margin for the segment.
Thank you. The next question regarding revenue guidance of around 552 million. What level of contribution is expected from acquisitions versus organic growth?
We are quite focused on having a balanced approach now, in terms of, growing also organically the business and looking also at the more selective approach in the M&A. What you look as the split under this new criteria that you have for Q1, we would consider this relatively stable for the rest of the year. That is, unless we don't see any, opportunities on the M&A that we could execute quite fast. But basically, that should be like a split, the split that you see now in organic versus M&A. So there is this split that we are considering for the rest of the year.
You highlighted investments in AI, data engineering, and cybersecurity as key growth drivers in the budget. Could you provide more detail on these initiatives, including their current scale, areas of focus?
Yes, I would go there. We cannot reveal exactly because they are not above the threshold of mandatory reporting. But I would say that all of three, they are different. They are growing at the different speed. AI is also important, especially going to where Porter mentioned, to transition from hourly based to more outcome based work. So AI, it's extremely instrumental in that respect, and that we presume, and we are fine tuning all the models, but we see there a big contribution in the profitability. That's one. Of course, if the price of token remains the same, but that's a different topic, I guess, in the industry. Talking about cybersecurity, we try to enhance more the capability there through the cybersecurity horizontal to add the cybersecurity function to existing customers and add also to provide more contribution. And talking about data engineer, we can talk about certification, big data and so on, where's the area that we see also with the potential. They are not at the level where they are highly important, but we monitor all these, and we are doing major step there.
How do you assess AI as a potential threat to AROB's business model? Are you seeing any pricing pressure or changes in client behavior due to AI adoption?
I'm happy to take this if you want, Waiku.
Yes, please.
Sure. I think AI is a threat to one business model and an accelerant to the other. The pure hours model has some exposure. If you sell all time and materials, AI means that same work bills fewer hours, and there is pricing pressure. We sell a mix today. We're deliberately transitioning towards outcome-based engagements where the customer need calls for it, because this is where AI makes us more valuable, not less. And I think a very important and underrated feature of AI is that it's growing the market. Companies use tools like Claude to build prototypes in days, and then they need them turned into production-ready code that can scale to their customer base. And that means easier software prototyping leads to more software project starts, and more of them need a firm that can help them bring that software to production and scale it. And so AI pressures the hours model and rewards the outcome model, and that's the direction we're moving.
Thank you, Porter. Then we move to the next set of questions. We have two. Where do you see the highest growth potential in the software product segment?
Yeah, so in the software product, we see a market change, but in the most favorable way. So there is a threshold that is reduced at the European level for vehicles that are 3.5 tons plus. And that that opened the market a little bit more. Plus, there is a big area of tachographs and the area where the Romanian European legislation wants more monitoring. And that's a potential in the software product within Romania. Plus, there is a trend of shifting from 2G to 4G at the data transmission level that might require in the future changing of the previous and old legacy equipment, I would say. So those are the three areas. Plus, there is development of the Indonesian market. So Indonesia is growing. If you remember, we started as a greenfield, and we'll definitely, I guess it's right now at the second place after Romania, overpassing Moldavia and Hungary for the time being, and also some other markets. So Indonesia, it's a huge market. It's pretty far from us, but we are sharing the same infrastructure, best practices, and the model that we implement in Eastern Europe. So actually is one of the potential growth market. And if there are any development, we'll report it later on, specifically on that with Ovidiu, which is the head of that vertical.
Thank you. You've answered also the second question. Therefore, we move to the next set. Could you provide more details regarding your upcoming contracts and pipeline visibility for 2026, 2027? In particular, do you expect to secure additional public sector government-related contracts in the near future? Also, how do you estimate the impact of PNRR-related investments and digitalization funds on AROBS business growth and revenue outlook over the next few years?
About the pipeline, we share what we can share, actually above the threshold of significance. We have visibility, and Aurelian mentioned a little bit about visibility on the automotive segment. But I guess the question is related to the pipeline. As you know, we are more happy, to share this, but we try to remain kind of in the area of being more discreet on this, and we let the result to speak for us. Talking about public sector, I guess there are contracts, of course. We are working extensively there. Maybe on the next meeting, we'll introduce our colleagues from Integrated Services to give more details about the work and what is the pipeline and potential. About PNRR-related investment, they are, of course, ongoing different projects. But as you know, Romania, it's under kind of political instability for time being. But all these projects are secured, contracting, and going further. Revenue outlook for the next few years, that's difficult to mention in that verticals. But as you see, we showed good results, the Q1 compared with Q1 last year, and definitely will continue that. But it's kind of difficult to predict what's going on and forecast.
Maybe if I could add a little bit here. At the end of last year, for the yearly results, we mentioned that we have an 80 million, revenue still in the contracts which are already signed. You saw what we have delivered for this quarter, 26 million. There are continuously all sorts of procedures and bidding auctions to which our colleagues are participating. This is an activity that is it's an importance for us, but with two things to mention. First of all, we will never see it growing as a percentage, very high percentage in the total turnover. We could consider that this is the current level, let's say 10-15% in the total revenues that we are aiming to have for this activity. And then we would prioritize, as you've mentioned also in our question, these kind of projects which are having funding secured totally or partially from non-reimbursable funds, because this is a certitude, that the projects will come to fruition compared with projects which are just from the state budget and where the pressure related to the deficit might delay the projects. I will also take the next one, and then
yes, let me read it out,
please.
Despite solid revenue growth and improved profitability guidance for 2026, the share price has remained under pressure. What concrete catalyst does management believe could drive a re-rating of AROBS stock over the next 12 to 18 months? And would management consider additional shareholder return initiatives such as buybacks or a dividend policy to support the share price?
Yeah, thank you. First of all, I will add some additional information to one question before, the one related to the geographies. So checking in the numbers, out of the increase of revenues compared with Q1 last year, almost 70% was generated by the states. So this is supporting also what we presented before related to our focus to the US market. Now, related to this price consideration that you are mentioning, we are seeing three areas through which we can improve on the on the price and on the valuation of the market for the AROBS company and for the AROBS stock. First is related to continue to prove that we are delivering to the budget, we are meeting the budgets, and we are implementing this one AROBS strategy of integrating, of increased efficiency and scaling, which would result in improved profitability, and also this will improve the valuation, both in terms of increased EBITDA, but also in terms of market perception related to that. The other element is related to the split on the business lines. We've mentioned also in the past presentations and in our strategy that we are aiming for changing a little bit in time the split between software services and software products, because software products are the ones which are bringing higher margins, repeated revenue, and basically the valuation of the company would benefit of more multiples valuation on that. So on the software products, on the software services, we are improving operationally the efficiency, increasing the EBITDA there, but also we are looking to change a little bit the split between those two. And last but not least, you saw that basically we have convened the GMS for a buyback program, which is one of the elements, and I'm moving to the next question, which we are considering also in terms of supporting the price share. So this buyback is a disciplined capital return tool, which is enabled by our strong balance sheet. We believe that at the 211 million in cash and the bank debt 0.9 times EBITDA, we can both support our plans in M&A and also buybacks. Buyback is an instrument in the market, and we could have the flexibility of multiple legitimate uses of capital that we could use. And the buyback should be there also for a stock ownership plan, for continued M&A, but also for this part related to supporting the price. And these three elements, we believe should be, this is our aim and this is our confidence that should support the re-rating of the AROBS stock in the horizon that you've mentioned.
Thank you very much. I see we have answered all the questions from the chat just in time, since 1 hour has passed. We would like to thank you all for joining us today. The next time we're going to hear each other is going to be after we publish the results for the first half of 2026, which is going to take place on 27th of August after market closes. And we are going to host a teleconference at the beginning of September. Thank you all, and we wish you a great day ahead.
Susanna, I would like to conclude our investor call meeting with celebration. So we celebrate 15 years in AROBS Moldova. So I would like to congratulate all my team there. Not that the one doing work day by day in Romania or in the US are important, but that's an important moment. After 15 years, we celebrate, in Moldavia with cakes and with the AROBS logo, and actually that's a good. So as you know, we are international. We are present in many countries, and maybe we'll continue even further with the other expansion. So thank you all. Thank you, everyone. Thanks, Moldavian engineers and our colleagues in the products area, and enjoy the rest of the day. Thank you very much.
Happy birthday, AROBS Moldova. Thank you all.